We're going to go through the ultimate tax strategy for 2023 that's going to save you the most amount of money, and it's a complete overview of every part that you need, and it's the most important parts that gives you the biggest leverage with the least amount of time and the biggest amount of savings. And believe it or not, the number one way is the entity that you use. Let's talk about this really fast. With a sole proprietor, it does save you money versus just working a job because you can deduct a lot of stuff. We have an entire video on all the deductions. But a sole proprietor does not save you any money on the level of taxation whatsoever, except for taking more deductions than working a job. It's the same thing with an LLC. They're both pass-through entities that don't save you any money. The LLC gives you liability protection in case that business ever sued. It doesn't come back to you as an individual. Now, the S Corp does have tax benefits. It is nothing more than how an LLC is taxed or a C Corporation is taxed. By itself, it's just a corporation, or your LLC can be taxed as an S Corp with what's called a 2553 form that changes how your LLC is being taxed. As an S Corp, if you're making a minimum of $30,000 to $40,000, you can save $3, $5, $10, $20, $50, $100,000 depending how much money you make, because you're always going to save on paying the additional Medicare tax, which starts to kick in. But it also saves you a tremendous amount of money on your self-employment tax, especially from anywhere from $30,000 to $150,000. Now, the C Corporation gets a terrible rap, but the C Corporation is insanely powerful if you know how to use it and if it fits your business. It doesn't fit a lot of businesses, but it can fit certain businesses, and it has a benefit that no other corporation has. It's what's called a qualified small business stock. It's section 1202 of the IRS, which states that if you hold a company for 5 years under qualified terms, you can sell that company and pay $0 in taxes. But overall, most people are better off being taxed as an S Corp, as an LLC, or strictly as an S Corp directly. Now let's talk about another super powerful strategy called income shifted. All of this is if you're in a higher bracket than someone else that you're already helping, you're basically pushing money into them at a much lower bracket. Let's talk about kids. Kids, the bracket, if they're under the age of 18, $0 as long as it's under $13,000, and they're doing legitimate work for the business. And there's a lot of things they can do for the business that can help you. How about your parents? Help your parents? Give them something that they can do in your business, help them out if you're already supporting them, and give money to your parents and put that money in a much lower tax bracket, especially for supporting them. Just ask yourself the question, who are you already supporting? And then how can you give them money to do a legitimate function for your business that saves you a whole bunch of money in taxes that you're already giving them the money anyway? Here's a huge one, turning active income to passive income. Active income is taxed at the highest level. It receives the most amount of taxation applied to it possible. Passive income is the lowest. What is passive income? It's either rents or capital gains. So what I'll explain to you is how to do so. Now, it is a little bit complex, I'm not gonna lie. The first thing you have to do is you can't directly rent to yourself. So you just can't take your building, rent to yourself and say, there you go, passive income. That doesn't work. Because what there is the rules of attribution. They made these laws changes in the 1980s, I think in 1986, that you have to follow the rules of attribution. So this way, you just can't create passive income by renting to yourself or your spouse. So how do you do this? You can do so by using a trust. And by using a trust, you can actually get around the rules of attribution, because remember this, if there's a will, there's a lawyer, and that's who made these rules. So using trusts can actually get you around this, but you can't do it yourself and you can't do it directly. Now let's talk about maximizing your deductions. First of all, if you are not maximizing your home office deduction, and by doing that, I'm talking about using your house as a percent of home used versus all of your expenses when it comes to property taxes, mortgage, whatever it is, you can actually maximizing it if you're using a percent of the home. If you do this directly as an LLC or sole proprietor, use Form 8829. If you do as an S Corp, you do it as a reimbursement back to you as an employee of the company through what's called an accountable plan. The next is learning how to use Section 179 of the tax code or using and/or bonus depreciation. And here's a big secret. If you use either one and you finance the equipment, you can write off every ounce of that equipment purchase, apply that to your income, and in many cases, write off almost your entire income. This way you can get all your income tax-free. And the last thing, this might sound incredibly dumb, is learning to maximize everything related to business. You'll be shocked how many business owners that I meet that don't write off their cell phone, or they forget all these expenses. Why? They aren't keeping good books. They aren't learning to master how to do their bookkeeping. Bookkeeping, accounting is the language of business. You need to know how to write off every single thing you're doing in business. You'll be shocked how many things you're doing wrong. If your books are dirty and you need to do a lot of work, clean up your books, find those deductions. They're all over the place. Now let's talk about self-directed write-offs, and these are huge. What if you can create a health savings account, an HSA, or create a qualified retirement, a 401k or an IRA, and you can self-direct that either through a solo 401k, self-directed IRA. They exist. Some even have checkbook control. And this allows you to not only write off all that money you're contributing from your taxes, but allows you to invest and grow that money tax-free. And in the case of an HSA, you don't pay any tax whatsoever on the way in or the way out, but it has to be used for medical purposes. Vehicles are a huge part of saving you money. If you want to maximize your savings, you can actually write off 2 vehicles. Just think to yourself, do you and your wife have a vehicle? Probably, in this case, if you're married, true. Now, what if you're using vehicle number 1 mostly for business, but the vehicle number 2 you aren't driving at all, you aren't using it as a write-off? Well, if you can drive that car just a little bit in business and apply part of this, get this correctly, it will save you a few $1,000s just by doing this, just by driving vehicle number 2 a little bit in business. It's actually saving you a couple $1,000s a year if done correctly. There are hundreds of ways to do this. It could take me hours to go through all the different ways to save you money on taxes. But here's the beautiful thing. We have a form. This is what we actually do. Don't try this by yourself. You can make huge blunders, get in a lot of trouble. Don't do that. We're professionals. We'll help you to sign up to that page like that. There's a link below in the description. Click on that. It'll go to a page that looks just like that. And then we'll go through this and see how much money we can save you. And if we can't save you a penny, we don't charge you a penny. It's really just that simple. Now, in the meantime, make sure you like, subscribe this video because it pushes up the algorithm. As I mentioned before, helps my marriage. Comment down below. I look forward to serving you more. We have tons of other great videos to watch.